And now we come to trade of the day, the highlights of this week's trades. Let's get into it. Good evening and welcome to Follow the Money, bringing you the latest updates on everything business, finance, the markets, and investment funds. Our top story this week, we're diving into a significant shift in investor behavior that's catching everyone's attention. With concerns mounting over a potential economic slowdown, US investors are flocking to money market funds at an unprecedented rate. In the first week of August alone, a staggering $48 billion poured into these funds, pushing total assets to a near record $5.57 trillion. Money market funds are often seen as a safe haven during periods of uncertainty. As fears of rising interest rates and economic downturn grow, investors are seeking stability in these low risk, short term investments. The Federal Reserve's aggressive rate hikes have played a significant role in this trend. With rates expected to remain high, investors are opting for security and attractive yields offered by money market funds, which now surpass traditional savings accounts in returns. This shift has been particularly pronounced among institutional investors, but retail investors are also joining the movement, looking to protect their capital in a volatile market environment. Analysts warn that while money market funds offer safety, they are not without risk, particularly if market conditions change rapidly. A sudden shift in interest rates or economic policy could impact returns and liquidity. The growing preference for money market funds also has a ripple effects across other asset classes as money flows out of risky investments like stocks into safer alternatives. As investors continue to navigate uncertain waters, money market funds are becoming a go-to strategy for capital preservation. But the question remains, will this trend continue or will market conditions prompt another shift in investor sentiment? Also, on Follow the Money, we're addressing a major sell off in the banking sector that has investors on edge. US bank stocks took a significant hit this week, plummeting as weak economic data reignited fears of an impending recession. Shares of major banks like JP Morgan Chase, Bank of America, and Wells Fargo fell sharply, dragging down the broader financial sector. The sell off was triggered by disappointing economic reports, including weaker than expected consumer spending and manufacturing data, which have raised concerns about the strength of the US economy. The Federal Reserve's aggressive interest rate hikes, intended to combat inflation, are now fueling fears that the US economy could be heading towards a downturn. Higher rates are squeezing bank profits by increasing the cost of borrowing while also raising the risk of loan defaults. With recession fears mounting, investors are fleeing from the bank stocks, which are highly sensitive to economic cycles. The sector's performance is often seen as a barometer for the overall economy, making this sell off particularly concerning. Analysts warn that banking sector's woes could be just the beginning if economic conditions continue to deteriorate. The rising probability of a recession could lead to a further decline in bank stocks and a broader market downturn. The financial sector's underperformance is a stark contrast to relative stability seen in other areas of the market, as investors seek safer havens in the face of economic uncertainty. As the market reacts to the latest economic data, all eyes are on the banking sector. Will these stocks recover, or is this a sign of more pain to come? Stay tuned as we continue to track the financial fallout on Follow the Money. That's all for Follow the Money this week. Thank you for joining us. Join us again next week in the latest updates in the world of money. Until next time, keep tracking where the money goes. Back over to the studio for Trade of the Day. Welcome to Trade of the Day, our groundbreaking weekly trading series, where we reveal the secrets to achieving consistent weekly profits in the fast paced world of day trading. Join us every week on this exhilarating journey as we decode the strategies and mindset needed to harness the power of the market and unlock remarkable financial growth. Whether you're a new trader seeking to build your wealth or a seasoned investor aiming to amplify your gains, our series is your roadmap to success. Get ready to revolutionize your trading approach and embark on a path towards achieving your financial dreams one week at a time. Also, we love to know where in the world you're tuning in from, so post in the comments below. A reminder that this is not financial advice and that trading comes with real risk. My name is Alice, and I help traders and investors who struggle with confidence to make money in the financial markets find consistency and scale to achieve financial freedom, time freedom, and location freedom. I believe trading is the greatest wealth building tool of all time, and everyone on this planet needs access to this skill. I'm on a mission to impact 1 million people through trading by 2030. Woo! Let's go. Coming up this week, this is how you could have made 5% in the market, taking one trade a week, using one model, risking no more than 2% of your equity, looking to make a 1 to 3 risk to reward. So you're risking 2% to make 6%. We had a total of 2 trades this week for a potential return of 4%. It's important to know that everything that we share here is how we trade at I'm the Trader. But before we dive deep into this week's trade of the day, let's talk about having a trading edge and what that entails. A trading edge is one of the 3 pillars every trader must have in their trading to survive and thrive in the financial markets. If you don't have these 3 pillars in your trading, you're setting yourself up to fail. Confidence in your trading edge comes from 3 things. One, understanding the market and how it operates. Two, having one trading model that has IPTA signatures. Three, having a plan and process that you follow every single day. Successful trading is boring. You're doing the same thing over and over again. This is the 3 step process I use to take trades weekly. Step 1, condition. This is based on a higher time frame directional bias. Step 2, stage. What sets up your trade? What does it look like? Step 3, execution. Can you execute? Have your entry criteria been met to get in that trade? The most important step is step 2, stage. Because once you understand where the market is going and you understand the setup, the entry is easy. Also, if you understand price flows that occur around key highs and lows intraday, you'll have everything you need for setup. Step 1, condition. Determine the higher time frame directional bias. Where is the weekly candle likely to go? What is it reaching for? This will give you your condition going into the week. Several factors go into determine the higher time frame directional bias. However, there are only 2 options. Is either you're expecting the weekly candle to expand higher or you're expecting the weekly candle to expand lower. Step 2, stage. What sets up your trade? What does it look like? First, we look at the economic calendar for the week. It lets us know when to look for a setup. We look for medium to high impact news drive to narrow our focus. We stock setup on calendar day and after the news release. The optimal days to trade this week were Monday, Tuesday, Wednesday, and Thursday. Secondly, we look at what sets up your trade and what does it look like. This will be your model. If your weekly analysis suggests that price is going higher, then you're in a buy program and should be hunting long formations. For our buy model, we want to see price trade below a key low, displacement higher causing a market structure shift. The displacement leg must have a fair value gap busy near the swing low. We wait for a swing high to form to anticipate execution. If your weekly analysis suggests that price is going lower, then you're in a sell program and should be hunting short formations. For our sell model, we want to see price trade above a key high, displacement lower causing a market structure shift. The displacement leg must have a fair value gap SIBI near the swing high. We wait for a swing low to form to anticipate execution. Step 3, execution. Once the stage is set, when and how do you execute? For execution, we're looking to enter on the fair value gap or order block created in the displacement leg that took market structure. You have 2 options here. You can either enter a limit order at the fair value gap or a limit order at the order block. We use the equilibrium of the range, which is the 50% of the range. You can also use the low hanging fruit option, meaning the one closest to price. Stop loss will go at the swing high for a sell and at the swing low for a buy. You're always going to be targeting a 1 to 3. It's important to know that you can have both models form in a span of a day or a week, but your high probability trades will be in the direction of your weekly program. Here are some factors to consider for high probability setup. First, we have time, the most important aspect of trading. At what time is the setup occurring? Then we have range. Where are we within the range? Are we in the upper, middle, or lower quadrant with respect to buy or sell? Then we have liquidity. Is there or does price create liquidity right in front of the fair value gap or order block? With regards to this liquidity, once price takes the liquidity and enters the fair value gap or order block, you should see an immediate reaction, letting you know that you're on side. Lastly, when can you no longer enter the trade? Where is your cutoff point? For me, once price leaves the 0.25 fib extension, I'm no longer interested in entering the trade. Trading is a solo sport. You have to make it unique to you and your personality. All of this sounds complicated, I'm sure, if you're hearing it for the first time, but it's really simple. You just need to show up on the charts and look for it. Now, let's head over to the charts and look for it in price this week. Welcome to Tracking IPTA. This week marked a significant growth in my trading journey as my understanding of price action deepens. My confidence is increasing and losses are becoming less impactful. Each loss now serves as an opportunity to analyze whether the trade is still valid and look for another entry point in the market. One key realization this week was the importance of placing entries at the 50% mark of the range. This approach helps me avoid missing the fair value gap, which isn't always visible on the time frame I'm watching. I also discovered that M1 price action within M15 PDAs offer excellent entry points with limited risk. This insight has not only enhanced my strategy, but also solidified my confidence in navigating the market more effectively. I finished the week with a 7.4 increase in equity. In dollar signs, we're talking $1,840. And overall, we're up on the account by 53.6%, which is $13,410. Let's get to hunting. Grab your tools. As always, we'll be looking at the charts in bar replay mode. This means that you won't be able to see my executions. However, you will be able to see my horizontal lines, which represent the time aspect of trading. The most important tool you need to track IPTA's movement: time. Now remember, even though I'm going to show you both buy and sell setups, it's important to know that your high probability trades will be in the direction of your weekly program. You can take counter trends with this model. For example, you can take sell setups, even if your higher time frame direction is bullish, and vice versa. It's just that your probability of winning reduces significantly when you go against the higher time frame directional bias. If you're new to trading, I do suggest only taking trades in the direction of your weekly program. We're going into this hunt with the understanding that you guys have already arrived at your higher time frame directional bias. This is a hunt purely for the setups. To the hunt, let's go. Monday, August 5th, trade of the day breakdown. We had the PM session sell formation. Let's get into it. As always, we start with the economic calendar, and as you can see, we had medium and high impact news come out at 9:45 and 10 a.m. Lunch session start, we trade above a key high. It was an AM session high. Displacement lower, causing a market structure shift below the key high. The displacement leg has a fair value gap SIBI near the swing high. We wait for a swing low to form to anticipate execution. For execution, we're looking to enter at the equilibrium of the range, which is the 50%, okay? So you would have been tagged in this trade right at the start of PM session at 1:30. You don't get to break even. You're taken out at 8 p.m. for a total time of 6 hours, 30 minutes in this trade. Drawdown in this trade was 583 ticks. All right. Bear in mind, this is a high time frame. Entries M15, okay, for a 2% drawdown, okay. So even though we took a loss, let's consider factors that made this trade a high probability setup. First, we had the time aspect. We're entering at the PM session, check. The range, we're in the middle to upper quadrant. We're in the premium for a sell, check. Liquidity, we don't have liquidity on this time frame, but we do have a lower M1 time frame high that it comes to take, and once it takes it, you see immediate reaction. So 3 out of 3 matching up to make this a high probability setup that lost you 2%, okay? Although this trade would have resulted in a loss, if you look on the M1 time frame inside of the M15 SIBI, we had a clean entry with less risk involved, okay? This is what I was talking about earlier, that I realized that M1 price action inside of M15 PD arrays offer you excellent entry points, all right? That limits the risk. For those that want extra confirmation before entering a trade or want to limit risk, this is excellent. However, it's important to note that this will not always occur, so prepare for many mixed trades. Due to the level of risk involved in this trade, I personally did this week waited for the M1 to give me an entry. As you can see right here, first I got in a trade and I took a loss. I'll explain it in a second. And then I got back in when they offered me a second opportunity to get in, and I made the money back for the week. So as you can see, 1:30 starts the PM session. We trade into the M15 CB that was formed after market structure shift. We're waiting for the swing low, comes into the 50% range into the M15 CB. It takes liquidity inside of the SIBI and displaces lower, leaving a fair value gap SIBI on the M1 time frame. Okay, so I entered in initially. I got in too early when it came in here on a 1 minute, took this liquidity here and displaced down and left this CB, I waited for 130 and then I entered in the CB. And as you can see, took a L. It came and took me out, took a loss. It comes back in, takes liquidity, displaces lower, leaves a fair value gap CB. And then I entered in here and rode it for a 1 to 3. So yeah, this is what I was saying about the M1 time frame inside of M15 PDAs offering excellent entries. So you could have actually entered at this CB. Your stop loss can go at at the high. It can go at this high right here, or it can go at this high or a little bit higher. It's up to you where you want risk tolerance wise. But I would place it up here because I've noticed that once it does this high isn't usually tested. So yep, and you begin your 1 to 3. Yeah, and that was the trade. Even though because it was a higher time from M15, there was too much risk involved in this trade. If I had gotten at the 50% here and pull my stop loss at the high, I'd be risking like half of my account, which is a no. Okay, capital preservation is key for me. So with this trade, I waited for extra confirmation to enter the trade. Like I said, you're not always going to get that extra confirmation. So prepare for missed trade. But that was the trade of the day for Monday. Even though it resulted in a loss, I didn't lose on the day because I waited for extra confirmation and I knew what I was looking for in price. Tuesday, August 6th, trade of the day breakdown. We had a PM session self formation. Let's get into it. As always, we start with the economic calendar. And even though on Forest Factory, we didn't have any news on this day, if you look on Econo Day, we had the 8:30 high impact news. All right. So during the PM session, we had price trade above a key high. It was a lunch session high and also an old high. Displacement lower, causing a market structure shift below the key high. The displacement leg has a fair value gap SIBI near the swing high. We wait for a swing low to form to anticipate execution. For execution, we're looking to enter at the equilibrium of the range. This candle closure would have confirmed this swing low, and you would have been tagged in this trade at the 50% level on this candle right here at 325, breaking even at 4 o'clock, taking out the trade at 6 p.m. for a total time of 2 hours, 35 minutes in this trade. Drawdown in this trade was 11 ticks for a 6% bagged and tagged. Let's look at factors that made this trade a high probability setup. First, we had a time aspect is the PM session, check. The range, we're in the middle to upper quadrant, we're in the premium for a sell, check. Liquidity, we have a short-term high right here. The price comes and takes into the 50%. And as you can see, once it takes it, immediate reaction to the downside, letting you know you're on side. 3 out of 3 matching up to make this a high probability setup that netted you 6% for the day. I missed this entry for this trade as the fair value gap, above the 50% range was visible on the M2 time frame. Let me show you guys. It wasn't visible on here because usually I'm looking to enter on if it's an M1 or M5 setup. I'm looking to enter just the fair value gap level just above the 50%. It wasn't visible on the M5, but as you can see on the M2, which is a time frame I don't even look at on a regular basis. I just once the trading day was over, I analyzed the setup and to see where I could have entered the trade, which is what I do every day after my trading day. I see where I could have entered the trade, where I missed the trade. So yeah, through my analyzing the trade and going through the different time frames, I saw the M2 had a fair value gap CB right above the 50%, which was right here, which is a time frame I don't look at. Hence why I missed this. I missed this entry, and this is the trade that got me to realize, hey, just use the 50% range. It's easy, it's coming up there. That's the one guarantee. 50% just makes it less simple. And also I'm going to start teaching my family members soon, and they're really not going to understand to look for the fair value gap in different time frames. So just to make it easier for them to learn, I'm moving the entry to just the 50. Once the swing low is confirmed, you place your limit order at the 50%. It even tells you the price and everything, okay? Just to make it simple for everybody. So yeah, that was the trade of the day for Tuesday, and making adjustments as we go along. All right. This brings us to the end of tracking IPDA. I just want to add that analyzing trades and adjusting your model is crucial for long-term success in trading. Each trade provides valuable insights into what works and what doesn't. By regularly reviewing your trades and refine tuning your model, you stay adaptable, you improve your strategy, and you increase your chances of consistent profitability in this market. Okay. As traders, we have to be adaptable. We have to be able to adapt to the market conditions and see and analyze what's working and what's not working. Okay. Thank you guys for tuning in. See you all next week. Every week, we have shown you at least one or more opportunities that could have netted you 5%. With a 2% risk, if you had taken all two trades this week, you'd be looking at 4% for the week. But remember, we're only looking for one trade that will net us our 5% and we're done trading. As traders, we must be content with enough and we must learn to limit trade frequency. The less you're in the market, the less of your money it will take. I hope you found Trade of the Day insightful and hopefully you enjoyed this one. Deciding to become a trader is the greatest decision one will ever make. It is the fastest way to build the life that you want. And too many of us fail at it. 90%. This is because we're not equipped with the right tools to ensure survival, let alone thrive. There is a way to succeed at trading. Trade of the Day is about showing you how we at I'm the Trader are doing it and how you can do it too. Always remember, this skill is not easy to master, but it's also not impossible. You only fail when you quit. Thank you for watching. See you all next Saturday, same time, same place. Happy hunting.